So today's topic is what happens when a short-term rental becomes a long-term rental, or what actually happens when the reverse occurs as well. So today we're going to cover a question that many real estate investors face once they start learning about the short-term rental rules under IRS Section 469. Specifically, what happens when a property that is qualified as a short-term rental with active material participation later becomes a long-term rental where you are no longer active. And then equally important, what happens in the reverse scenario when the long-term rental becomes a short-term rental. We're going to walk through how this depreciation works, how cost segregation behaves in either of these scenarios, and then how your losses are treated and how the IRS applies the passive activity rules in each of those years. So this is a deep dive. Are you ready? So first, the IRS classes activity 1 year at a time. Everything in this video hinges on one rule. Under the passive activity rules in Section 469, the IRS classifies each activity on a year-by-year basis. That means the status of the activity this year does not change the status of losses from prior years. So this is the annual activity grouping rules in Regulations 1.469. So if your property qualifies as a short-term rental with material participation in 1 year, losses for that year are active. If the same property becomes passive the following year, that does not affect last year's classification. So that's point one. Now, point two, what happens when a short-term rental becomes a long-term rental? Well, during the short-term rental years, if the average stays were 7 days or less, and you materially participated, the IRS treats that activity as an active trade or business rather than rental activity. This allows the losses, including those that we generate with bonus depreciation and cost segregation, to offset W-2 income, business income, and other non-passive income sources. If the following year you then transition that property into a long-term rental, the activity then becomes passive unless you qualify as a real estate professional and materially participate in that new long-term rental activity. So here's the important part. Losses from the short-term rental year do not become passive. They remain active permanently. This is true even if 10 years go by and you never materially participate again. That's a really, really important point. So the next section is then what happens to the depreciation after a conversion. The depreciation follows the property, not the activity classification. If you completed a cost segregation study during the short-term rental phase, the reclassified assets keep the same useful lives. Depreciation continues on the same maker's schedule. That's the type of depreciation. You do not restart depreciation. You do not change the class life. You simply continue taking the remaining depreciation each year. But the losses are now subject to passive activity rules. Cost segregation and bonus depreciation still remain valid. A change from a short-term rental to a long-term rental does not undo a cost segregation study. All of the accelerated depreciation taken during your short-term rental years remains valid. The reduced basis remains permanently reduced. Those deductions are not reversed or recaptured simply because the properties now become a passive investment or passive activity in subsequent years. Recapture only occurs when you sell the property, and that comes under sections 1245 or 1250 property. That's how we define property in the tax code. Now, future losses after the conversion may become passive. So once the property becomes a long-term rental, future losses are passive unless you qualify as a real estate professional and you materially participate. Future depreciation, operating expenses, repairs, insurance, and other costs, those generate passive losses that may be suspended. So they're kind of hanging there waiting to be applied if you do not have passive income to absorb them. The reverse scenario, if you take a long-term rental and then convert it to a short-term rental, this is kind of reversed. If a property begins as a long-term rental and you have suspended passive losses from that, and then you later convert that to a short-term rental property and you're materially participating, that activity becomes active for the later tax year, not the prior tax years. Future losses generated in the new year would be treated as active because that activity meets the short-term rental rules. However, any suspended passive losses from the prior years do not convert to active losses. They remain passive. They must be absorbed by future passive income or released when you dispose of the entire activity in a fully taxable transaction. So this rule is outlined in section 469 and regulation 1.469. And then finally, in summary, for short-term rental years, you can create large active losses, especially when using cost segregation. These losses remain active even if you convert the property to a long-term rental. Depreciation schedules, they stay intact. Cost segregation remains intact and valid. Only future losses in long-term rental years then become passive. So in the reverse situation, passive losses from long-term rental years never convert to active losses, even if the property later qualifies as an active short-term rental. So it's dictated by the year that you put that into service and the year as to whether you were active versus passive. Understanding these distinctions really help investors avoid some of the common mistakes and then better plan their tax strategy for how to implement or when to implement cost segregation and how to place a property into service. If you have questions about how these rules might apply in your situation, or if you are considering cost seg on a short-term rental or a long-term rental property, Engineered Tax Services can help you understand the impact, model the potential savings, and our team specializes in IRS defensible, engineering-based cost segregation studies. We support taxpayers and CPA firms nationwide. Reach out anytime if you want a complimentary benefit analysis, and we can help you navigate these rules.